All right, here we are going live. Super excited to be back with you guys live right now. We have a lot to go over. And I know the dying question on every single one of your minds right now is, what the heck is going on with Bitcoin? But we're not going to talk about that right now. We are going to do a live Q&A on the back, and we can sit there and talk about any Bitcoin questions or chart questions or prediction questions that you want. But right now, we're not going to talk about that. We'll talk about it later because I know you all want to. Real quick, just let me know if you can hear me. Just put it in the chat right now, like a yes, a loud and clear. Yes, I hear you, something like that. Just want to make sure the audio is good before I start going too far. Can I just get like a yes, I hear you, something like that? Yes, okay. Yes, yes, yes. Okay, loud and clear. All right, good. Just want to make sure before I start talking for too long that you guys hear me. Now, just real quick, I also always want to ask you, where are you from? Drop it in the chat real quick. Where are you from? Let me see that. Let me see where you're from. Tanner, maybe you can just zoom out just a little bit. I know. Maybe we can just zoom out just a little bit. Yeah, a little bit more. A little bit more. Yeah, that's very good. All right. Can you scroll up, though, so I can see the chat happening in real time here? There we go. All right. It should just leave it, and it should just scroll. All right, there we go. Oregon, Long Beach, California, Miami, Florida, Brisbane, Australia, Sacramento, Switzerland, India, Long Beach, California, South Carolina, Australia, Canada, Kansas City, Missouri, Berlin, Toronto, Canada, Maui. Wow, the UK, Texas, Argentina, Washington, Republic of Washington. There we go. La Quinta, California, Germany. It's midnight in Germany. Wow, thanks for staying up. Hope you got some coffee. Canada, Italy. Wow, all over the place. Well, that's good. I always love to see where the audience is coming from so I can make sure that we're addressing this for everybody. But what I'm going to teach today is principles. I like to say principles are few, methods are many, millions of ways we can apply these methods, all right? But these work for you no matter if you live in Croatia or Australia or Canada or Denver, Colorado or Virginia Beach or Portugal, all right? These work. These are principles. And except for maybe a couple countries with some like really extreme, crazy things going on, which we'll talk about a little bit later. Maybe if you live in one of these small third, fourth tier countries, maybe. But for the most part, everybody I see here, this applies. All right. Now, I do want to say, I'm going to go ahead and jump in here, but while you didn't pay to attend this training, and when I say that, because I just did 3 days of live training about a month ago in January, and we did charge for that, but I was live for 3 days here. I'm going to give you sort of the abbreviated version of this. And you didn't pay to attend this training. However, you did put in the time. You did put in the time. You put in the effort to coming. Some of you up are at midnight right now, right? You cleared your calendar. You showed up. And so the reason why I'm saying that is because that right there already puts you in a different category than 99% of people out there, right? So let's make this worth your time. I'm going to do my job. I want you to get the most out of it. I want you to do your job. Get the most out of this right now. Now, for probably, I'm not really sure, the next 50, 60 minutes, I'm going to show you something that most people never see. It's not new. It's not secret. It's just 99% of people never see it because it's what the 1% have done for a long time. But how many 1% of people do you know? And do you look at their finances on a regular basis? That's why you don't see it. I want to show you how to build a wealth engine that runs 24/7, 365, whether you're working or not, regardless of what the markets are doing, all right? Now, before we get into that system, I want to show you something. And I need you to actually do this with me, okay? Now, hopefully you have a pen and a paper. Get that pen and a paper out because this is interactive, all right? This is not just me singing and dancing on stage. If you'd like that, you can just watch my YouTube videos. This is a workshop. So get a pen and paper, get ready, close out your internet browser tabs, put your phone on airplane mode, put it in another bedroom so you don't even see it or whatever, and let's get down to this, okay? You guys with me? You guys ready to do some work? Give me a thumbs up if you guys are ready to do some work. I need your agreement first. All right, there's a little bit of a lag here. I'm just waiting. All right. Yes, yes, yes. All right. We're ready to do some work. You got your pen and your paper. Okay. Let's get down to business then. Now, oops. Okay. First thing is, I like to do this. I call it the magic wand. All right. So as I said, you guys are already in the 1% because you've already dedicated time. You've already put this on your calendar. You've already shown up. I know you're a high performer. I know you work incredibly hard, right? So then let me ask you something. Close your eyes and imagine with me for just a second here, a couple seconds. If I had a magic wand and I could give you any net worth that you want, any lifestyle that you want, any level of freedom that you want, what would that be? What would it look like? Write down one thing that you just thought of. Just one. Don't share it yet. Just write it down. One thing. Okay? Got it? Good. Now hold on to that. Okay, we're going to come back to that. But did you notice something? Because when I ask people what they want, nobody says, I want to work harder. What you probably wrote down, if I'm guessing, because I've done this a bunch, you probably wrote down time. You probably wrote down time freedom. You probably wrote down options, security. Maybe some of you said you wanted to travel. You want time with your family. Right? But here's the problem. When I ask you what you're doing to get there, what are you going to say? Think about it. You say, I'm working harder. I'm trying to earn more money. I'm trying to save more. I hope that my retirement account, my 401k grows. I hope Mark gives me some good investment tips here so I can grow my wealth. That's what you're thinking, right? But do you see the disconnect? What you really want, I bet 99% of you said time or time freedom. That's what you want, time. But right now you're trading more time for more money. You want freedom, but you're building a system that requires you to keep working in order to maintain the system. And so something's broken here. Now, what's broken is not you. Don't worry, you're not broken. Here's what's broken. You're imagining life, or I should say, not imagining, you're managing your life through a P&L, profit and loss. If you have a business, you have a profit and loss statement you look at every month, at least you should, you better. But even as a household, you have a budget, you sit down, hey, here's how much income we had coming in, here's how much expenses we had going out. And so we manage our life like a P&L, profit and loss. What does that mean? It means that we optimize for revenue. We're trying to get more profit in the door. I'm trying to make more money. How do I make more money? How do I increase my income? Right? Here's the problem with that. Revenue is vanity, but your balance sheet, that's your destiny. Now, your life isn't going to improve when your W-2 income improves. Your life will improve when your balance sheet, when your assets improve. You see, I'm going to break this down for you, but we can have two different people that both earn $500,000 a year. Both of them earn $500,000 a year. Both of them spend $450,000 a year. But they live in two different completely universes. One maybe builds up a net worth of, say, $200,000. The other one could build up a net worth of $500,000. Same income, same spending. One's not skimping their Starbucks every day. Same income, same spending, but they use a different system. Okay, now here's what this gap, this disconnect costs us. So let's say that you have, 15 years until you want to retire, until you want financial freedom. I like to call financial freedom because I don't ever plan to retire. I don't think we were meant for retirement, but we'll call that financial freedom. So on the income game, I'm saving $50,000 a year. I'm investing that. I'm getting above average returns of, let's call it 8%. That's above average. Ray Dalio's fund, Bridgewater Capital, all-weather portfolio does about 7.6 over the last 2 decades. The most popular 60-40 portfolio is about a 6.4%, but let's call it 8. So if I did that, if I was able to put $50,000 away per year, making above market rates at 8%, and I did that for 15 years, that's about $1.5 million. It's pretty good. But if I play the asset game and I built my assets instead, I could turn that same amount of money in 15 years into, say, almost $8 million. It's a big difference. The cost of staying on the income treadmill is $6.2 million. That's what you lose, the $6.2 million, the cost of inaction. That's the cost of staying on that treadmill. That's $413,000 per year. That's $34,000 per month. That's $1,100 per day. Every single day you wait. Every single day you wait, you lose $1,100 in future compounding. Type ouch. Type ouch in the box right now if that hurts. Okay? Type ouch. That's not 15 years from now. That's today. That's the cost of the wrong system. Ouch, ouch. There we go. Okay, I see it. You guys are feeling that. All right, now, you already know that the wealthy play a different game. Right now, as we're talking, Michael Saylor's given a press release for Q4 numbers of his company, MicroStrategy. We're going to talk about what he's done, and he didn't create this, but you know that he's playing a different game, and I'm going to give you an example. So Michael Saylor ran a company called MicroStrategy. It was a software company, and you can listen to him on multiple podcasts talking about how for 2 decades he tried to grow the business. He said he went around the world 10 times. He hired people, he fired people. No matter what he did, he couldn't get the revenue up. He had about $500 million in the bank account, but what's he going to do? Should he buy another company? Should he try to launch another software product? For 2 decades, he proved to himself, no matter what he does, he couldn't grow the valuation of the company. It was stuck at about $2 or $3 billion. So he decided to pivot. In 2020, he decided to change. Instead of chasing revenue like us, at some point, all of us were going to hit the cap. Our revenue is going to be capped out. There's only so many hours you can work in a day. There's only so many side hustles or side businesses that you can start. Your business is going to cap out. So just like Michael Saylor, eventually we find ourselves plateaued. So what he did is said, you know what? Instead of trying to grow the revenue, instead of being on a profit and loss, I'm going to run a treasury strategy. And what the treasury strategy is going to do is I'm going to manage the company like a treasury, not a P&L. Instead of trying to grow revenue, I'm going to grow the assets. Within 5 years, he took a company that could not grow after 2 decades. And within 5 years, he took it from 3 billion, where it was stuck, to 50, from 3 to 50 billion. And he didn't earn more revenue. He didn't earn any more revenue. He didn't sell any more software. He didn't work harder. What he did is he changed the system of how he's building wealth. Now, look, I'm no Michael Saylor, and neither are you, right? Neither of us probably have $500 million sitting around in a bank account. But what we do have is we have access to the same 3 moves that he used. We can copy the same 3 moves. We can copy the strategy. The third one does 80% of the work. Now, time is dwindling down, so I don't know now, in the next 50 minutes or so, I'm going to show you how to build that system. It's a treasury system. It's a personal treasury system that can fund your life without having to sell your future. But first, let me show you the first move, okay? This is the shift that you need to make. Now, what we want to do today, we want to make the shift from a worker mentality, a worker approach to the game, to a treasure, like what Saylor did. As a matter of fact, he changed his company's name. He dropped the micro. So instead of MicroStrategy, it's now called Strategy. And we want to do the same thing. We have to change our identity from worker to treasure. Now, a worker trades their time for money. They optimize their income. They work harder. They schedule more work in there. They grow their skills so that each hour earns them more money. That's great. But they manage their life like a P&L, trying to make more profit. And then, how do I spend less money? How can I skip my morning coffee? How can I take one less vacation? How about if I never take my wife out to dinner and I just save my way to wealth? How do I save more? How do I cut expenses? When they need cash, the worker mentality, when they need cash, what do? They sell assets. They're afraid of debt. Dave Ramsey says, never use debt. It's dangerous. And they're working on a 40-year retirement plan. A 40-year retirement plan. That plan requires them to keep working forever to maintain it. Now, the treasurer on the other side, their assets work 24/7. Whether they work or not, the assets are working. Instead of optimizing for profits or revenue, they're optimizing for collateral, not income. They manage their life like a balance sheet, not a P&L. When they need cash, they get liquidity against assets. The assets fund their life. They never sell. They use leverage, but they use built-in safety systems. And they're building a generational wealth plan that outlives them. Now, it's the same person, just a different operating system. Now, real quick, I'm sure if you guys have been watching me for any period of time, you've heard that I had to learn this the hard way. There's some lessons in life that can't be taught, they can only be learned. And unfortunately, I had to learn this one the hard way. And I had built up a lot of wealth. I had built up 2 different tech companies, 2 big exits, a huge real estate empire. 2008 came, the great financial crash, and wiped me out. Millions gone overnight. Now, the problem that really led to this is that I had assets, a lot of assets, but I had no system. So what happened is when the market crashed, I was a forced seller. One of the number 1 rules, Warren Buffett says the number 1 rule with investing is to never lose money. I say the number 1 rule to investing, which I guess sort of coincides with his, is never be a forced seller. And I was a forced seller. I was forced to liquidate my real estate portfolio at the very bottom of the market. Liquidation death. If I could have held the real estate today, it's worth way more. I'd be really rich if I had it, but I don't. I'm forced to liquidate down there. Now, after that, I still had my mental capacity. I still had my skills. I still had my relationships. So I started making money again. And I started making money pretty quickly. Within a couple of years, I was back up to making almost $1 million a year. But I had PTSD. I was so afraid of what had happened to me. I vowed to my wife, I vowed to my family, this would never happen to us again. And so I was terrified of credit. I didn't want to use any credit because what happened last time is I used credit and then I couldn't afford to pay it. And then I lost everything. And so this time I'm just going to stay away. And I was making good money. So I paid cash for everything. I paid cash for my cars. I paid cash for my houses, all my business expenses, everything was cash. But I realized after years and years, 6, 7 years, I realized that even though I was making a high income, my lifestyle got back on track. We had the big house. We had the nice cars again. We were living a nice lifestyle, but I wasn't building any wealth, barely any wealth. Like, yeah, my income was giving me a good life, but my wealth, my assets, they were growing, but they were growing very slowly. So I wasted about 7 years of my life making great money, but building, almost zero wealth. Why? Because I was still thinking like a worker, right? I was working hard. I was making a lot high income. That was great. I was hoarding cash. I was afraid of leverage, and I managed my life, my expenses like a P&L. Now, by 2015, I'd been going to all types of masterminds, trying to get access to as many of these wealthy people as I could to learn what they were doing. I knew there was another system out there, and I learned what the wealthy do. And I learned I had to stop thinking like a worker. I had to start thinking like a treasurer. And it's that one shift that changed everything. Now, real quick, raise your hand well, maybe we can't raise your hand in Zoom. We're not in Zoom, we're in Webinar Jam. Just give me a thumbs up. How about a thumbs up if you've ever sold an asset to pay for something? Ever sold an asset to pay for something? Maybe it was stocks, Bitcoin, real estate, whatever. Have you ever sold an asset to buy a car? Sell an asset to pay a medical expense? Sold an asset to go on vacation? Okay, so I got lots of thumbs up. Lots of thumbs up. And if you don't have a thumbs up, then you probably never had an asset before. Because that's what we do, right? We buy an asset low and we sell it high, right? Buy low, sell high. And then we sell high, we take some of the money and we buy stuff, right? The few people that don't have their thumbs up, again, probably didn't ever buy anything. Almost everyone, as you can see, but that's worker behavior. But it's not your fault. It's not your fault. You were never taught the treasurer way, but you're about to learn it right now. Okay? So you won't have any excuse after this. Now here's the switch. As of today, here's what we want to start doing. We want to stop trying to build wealth with income. We want to stop playing the, if I earn more, if I save more, I hope that it works out and I can retire in 40 years. I hope that I die before my wealth goes to zero. But that's a profit and loss strategy. It's a P&L strategy. And you just saw that it's costing you maybe $1,100 a day. So what we want to do is we want to start building wealth with assets instead. So we have collateral. The collateral provides us with liquidity, and the liquidity is what pays for our lifestyle. That's a balance sheet strategy. That's what Saylor did. That's what the wealthy do. And that's what we're going to do right now. Okay, so what we're going to do, I'm going to show you 3 wealth engines. I call this the wealth operating system. So just like my phone, it has an operating system that's built in here, and it runs all the different apps together. We have 3 wealth engines, and we build these together. There's more than 3, but I'm going to give you 3 main ones. And we build all these engines together, and they create a wealth operating system. We're going to go through 3 of these wealth engines, how to build them, how they work together. And at the end, I might invite some of you, if you want, to book a personal treasury audit with my team. And on that call, we'll help you build out a balance sheet x-ray, your collateral map, your liquidity stack. We'll design your entire system with you, but we'll get back to that later. But for now, let's build the engines. And I want to show you the 3 engine upgrades. Okay. So engine number 1 is our base engine. We need to build the engine. You can't just go buy like a cheap car engine and then throw like a bunch of like high performance supercharger stuff on there. Like you'll blow the motor. You got to build the right motor first. We want to build the base engine. We want to put all the good parts in it. And this is our treasury operating system. It's the base foundation, the engine. Call it 300 horsepower. Some of you guys are car guys. There I see Aaron says, as a car guy, I approve of these graphics. All right, so you guys understand it. As a car guy, I need to make sure that my engine is powerful enough to handle the additional upgrades I want to put on it. And this is what we call the Treasury OS, the Treasury Operating System. OS stands for Operating System. All right. Now, this is where our assets will fund our life, not our income. The goal is once we have this base engine going, instead of working for money, using the money to pay for our life, and if we have a little bit saved at the end, we can invest. Instead of that, we work to make money to buy assets, and then the assets pay for our life. That's it. That's engine number 1. Now, then, once we have the base motor built up and it's strong enough to handle the upgrades, engine number 2 is the supercharger. This is going to be income and tax optimization. And this is where we can reclaim, we can redirect, I don't know, 100,000, 200,000 or more per year in taxes. And that's money that would have gone to the government, any government, doesn't matter what country you're in. And then you can, instead of sending it off to the government, you can invest it instead. Okay, now that's going to take our base motor from say 300 horsepower to 650 horsepower. We're pushing serious power. We're going really fast. But then engine number 3, this is the nitrous oxide. This is the velocity engine. And this is where you're going to discover how to activate what I call lazy capital, lazy dormant capital. I'm going to explain what that means as we get deeper into that. But it's how we can get $1 single dollar. Instead of doing $1 doing 1 job, we can get $1 doing 5 jobs. And this will take our engine from 650 horsepower to 1,000 horsepower engine. We'll be building wealth at an extremely rapid rate. Now, remember when I said that Sailor uses 3 moves? I said that the third one that he uses, that we can copy, does about 80% of the work. Okay, this is it. This is engine number 3, the velocity engine. That's the nitrous. Now, give me a thumbs up. Quick show of hands. Who wants to skip straight to engine number 3 right now? Give me a thumbs up. You want to skip? Should we just skip straight to engine number 3? Yeah. Yep. Everyone does. Because that's where the magic happens. Okay, that's where the magic happens. But the problem is, if you try to inject nitrous oxide on a 4-cylinder engine, you're going to blow the whole engine apart. This is how people blow themselves up. They try to use advanced strategies, but the motor isn't capable of it. Okay, so we don't want to skip ahead. We have to do this in sequence. We build the base engine first. You put the supercharger on second, then you can handle the nitrous oxide. Okay, so stick with me, and we're going to build it right. We're going to build it right. We're going to start with the foundation, engine number 1. Okay, so engine number 1 is our base layer. And let me show you why the income game is rigged. So let's say that you're making $500,000 a year. Now, depending on what state you live in or what country you live in, probably at least of that 500, probably at least 200,000 goes to taxes. So you live off the 300 that's left, and you're super disciplined, and you manage to save, let's call it 50,000, right? That's 10% of the 500. And you invest it into index funds, like I already said, at like 8% that outperforms the market. 20 years later, you have about $2.5 million. But here's what they don't tell you. Inflation, the real inflation, it's not CPI. It's not that. CPI. It's not that. But the real inflation, which is the rate of the monetary expansion, cuts the amount of money that you saved in half. So now you don't have 2.5 million. Now you've got 1.25 million in buying power and purchasing power. Then you retire. And then what do? When you retire, you start selling your assets, right? You start selling your assets. And then what? You have to pay tax on that. So now you're paying at least 20% on taxes on that. So now you're at like $1 million. So you earned 10 million over 20 years and you kept one. It's terrible. Hopefully that makes you mad. But here's why it fails. Failure number one is your income maxes out. Again, right? Like we can only make so much money. Like Michael Saylor tried for 2 decades. He could not grow the business. Eventually, we all hit a ceiling. As I said, right, the cost of living is going up about 10% a year. The cost of your homes, your gas, your insurance, your steak, all those things. But your income most likely is going up about 3 or 4%. So you can never get the income to go up as fast or faster than the rate of your cost of living going up. But meanwhile, we can get assets going up at 20 or 30%. So wouldn't it make sense that we would want to get our assets to outrun our life increase? So failure number one, your income maxes out, right? At some point, doesn't matter if you're a business owner, doesn't matter if you're a W-2 employee, this doesn't matter. But at some point, you can't just 10x your income. Failure number two, inflation destroys you, right? The real inflation, like I said, 10% per year. So if you're earning 8% on your investments, which is beating the market, right? It's probably about 7.5%, 6.5%. You're losing 3-4% a year. Failure number three, retirement then forces you to sell. So I'm going to quit one day and I'm going to start selling my assets to live. But the problem is the compounding stops. You start dying financially. Your money is dying. Now here's the proof that this system never worked. 50% of baby boomers today, the largest segment of the population, 50% of them have zero money saved for retirement. That's how well that's worked. The other 50% that do have some money, it averages about $240,000. So that's good for a couple $1,000 a year. That's the income game. Okay, here's the switch though. You see, the old engine is I earn money, I pay tax. If you're a W-2, the government takes their money off the top. At least if I'm a business owner, I get to keep it a little bit longer. But I earn money, I pay tax. Whatever I have left after that, I can use to fund my lifestyle. And then whatever I have after that, if I scrimp and save, then maybe I have a little bit to invest at the end. And then I hope that it grows, and I hope that it doesn't run out before I die. So I'm trading time for money, I'm maxed out, and then I have to sell all my assets in retirement, I die with zero. The new engine, the engine that we can build as a treasury first, the treasury operating system, is I earn money, and I take the earned money and I put it into assets or collateral. Tax optimized, tax deferred. We're going to get into that. Then I use that collateral, I use those assets as liquidity. That liquidity funds my lifestyle and builds my wealth. So I'm now building assets that work 24/7, 365, the assets to fund my life. We never have to sell our winners. This is how the wealthy operate. Michael Saylor is not selling his Bitcoin to live. He used the assets to pay for his life. That's why I said earlier that revenue is vanity, balance sheet is destiny. All right, and here's why we want to run this. Well, I've already given you several reasons, but let's look at another one. There's 3 costs to selling. So the traditional plan, again, make some money, pay some taxes, live on what's left. If I have a couple bucks extra, I'll save it. And then when I want to retire, I start selling my portfolio down. But here's what happens. There's 3 costs. Number 1, compounding. Compounding stops. Now, what does compounding mean? It means it grows on top of the growth, on top of the growth, on top of the growth. That's not linear growth. That's exponential. That means that 1 million turns to 2, 2 turns to 4, 4 turns to 8, 8 turns to 16. It gets crazy. But if I sell, I interrupt the compounding every single year. On top of that, when I sell, I have to pay taxes. So now not only do I lose the compounding, I also lose the taxes that I have to pay up front. So I have a smaller base as well. Then that's the tax drag. And then third, I lose the opportunity cost of being able to have the money. Okay. All right, so what we want to build out in our base engine, there's 4 components. Hopefully you're keeping notes. And each of these four components in the base engine solves different problems for us. Assets are like tools. You know, one of the most common questions I've got is, Mark, what asset should I buy? Should I buy Bitcoin right now? Should I buy a rental property right now? Do you like gold? Should I buy gold? How about treasuries? Are stocks a good time to buy stocks? Like, what about these meme tokens? Like, assets are like tools in a toolbox, right? If I had this like master set of tools, like a professional auto mechanic, for example, and you're like, hey, Mark, throw me a tool. I'm like, okay, do you want a screwdriver, or do you want a wrench, or do you want a hammer? Like, what do you want? Well, it depends. Right? Assets like tools, they all serve a very specific use case. And most of you don't know the difference. So the solution is what we call the balance sheet X-ray. All right, so we're going to classify every asset that you own. Is it collateral? Is it a productive asset? Is it a dead weight asset? Problem number two is that we think that liquidity is cash. So in order to not get liquidated like I did in 2008, in order to build wealth like Michael Saylor, we have to learn how to do it safely. Otherwise, we blow ourselves up. That's why Dave Ramsey tells people don't do anything that can blow you up. But that's like saying never go into the ocean and go swimming because you don't know how to swim. We could learn how to swim. We could learn how to swim and we could put a life jacket on. And so we have to understand that liquidity is how we don't blow ourselves up. But liquidity is not cash. So a lot of you think you have to hold a lot of cash for safety. But cash is liquidity, but liquidity is not cash. Okay, then so that's the collateral map. We want to build that out. That's how we can find out how much liquidity we can access, when we can access it, how we can access it. Problem number three again, is that most of us are one emergency away from being forced to liquidate assets. Remember, never be a forced seller. I got some calls from people today that are facing some serious liquidation costs. They're asking me for if I can give them some solutions. There's massive liquidations that they're facing. One emergency away. So the solution is to build out a 4-layer liquidity stack. Layers 1 through 4 all serve different purposes to grow our wealth fast. Layers 1 through 3 really protect the growth of layer 4. And then problem 4 that most of us deal with is that we view credit, we view leverage, we view buying assets in this multiple layered strategy as risky. We misunderstand it. So what we want to do is we want to build out a risk and leverage policy. This would have like loan to value caps. We'd stress test our portfolios. We build liquidity buffers. All right. This is what I didn't do. This is what I didn't have in 2008. If I did, it would have saved me a lot of money. Now we put those 4 together. You've got your 300 horsepower engine. You've got your assets to fund your life that you never have to sell. And that's before we add the supercharger and the nitrous on. Now, I'm not going to teach you how to build all 4 steps of these right now. That's what we do at our personal treasury audit. But let me show you what happens when you do build them out the right way. Okay, so like Michael Saylor in 2020, right? We talked about this. He had $500 million in cash sitting in the bank. It was kind of dead weight, right? He's like, look, I was sitting on a melting ice cube. The money was losing so fast because in 2020, right, the government was printing money so fast. He's like, it's literally melting. Right now, it's losing about 10% a year. In 2020, it was a lot faster than that. And so he made the switch. He swapped the cash for Bitcoin and put Bitcoin in for whatever asset you want. But he swapped the cash for assets that became collateral. Then what he did is he used 2 different tools that we have available to us, one being credit or debt, and the other being equity. And he used the credit and the equity to start to build up his asset base. He used the credit and debt and equity to buy more collateral, more capital. And then he used the capital and collateral to get more credit and equity, and he used the credit and equity to buy more capital. He never sold it. He just kept stacking collateral, renting liquidity against the capital, buying more capital, renting liquidity against it. 5 years later, he went from 3 billion to 50 billion. All right. Now, this is not a Bitcoin story. It's a treasury story. And I know, like you and I, we're not starting with 500 million. Maybe you have, 100,000 or 500,000 or a million. Doesn't matter. The move is the same. The move is the same. We have the same tools at our disposal. Let me show you someone maybe that's more like you who did the same move. Now, Sarah is a real estate investor in California. She came to us thinking that she had maybe like a couple 100,000, maybe 500,000 in spare capital. But we ran an audit. We found out she had 2 million in sitting dormant capital. Now, what does that mean? And how much do you have? Well, I'm going to walk you through that in just a minute. So we're going to figure that out for yourself. But she had about 2 million sitting dormant that she didn't know about. Home equity, 401k, Bitcoin, cash and savings, all of it doing one job. So we built her a collateral map, activated 50% of it, about 1 million of that. We deployed it into cash flowing, tax advantaged assets, built her 4-layer liquidity stack so she's never at risk of getting liquidated. And here's what her life should look like in about 20 years on a conservative basis. If she does nothing, if she doesn't do any of this, she'd end up with about $5 million. Pretty good. But then she'd be forced to sell those assets to live. She'd be paying taxes and all of that. And she'd hopefully die before she hit zero. But if she activates, let's just say even call 50% of her dormant capital and runs the system, it'd be 42 million. Never have to sell assets. Generational wealth. This is for your kids, your grandkids, your great-grandkids. So her cost of waiting is about $36.5 million. That's what the base engine does. Now, we had to run through that dormant capital audit. I'm going to show you that, but type Sarah in the box if you're wondering what your dormant capital number is. All right, now Sarah's not alone. Yeah, I see a bunch of Sarahs. We're going to help you get there. Don't worry. I got this coming here in a little bit. But Sarah's not alone, right? Mike in Texas, he found 1.2 million in dormant capital, activated about half of that, about 600,000. And now he has cash flow of about $72,000 a year coming in tax-free. Tax-free. Doesn't have to sell anything. Lisa in Florida had about 800,000 in her 401k, unlocked it, put it into some miners, which is one of my favorite ways to get some tax depreciation. I'm going to talk about that more later. And she's on a path to $6 million in 15 years. Tom in California, real estate guy, 2 million in equity doing nothing. Pulled some of his equity out, bought 3 more properties. Now his cash flow doubled. Jessica in New York, 400,000 in Bitcoin, borrowed about 120 against it, deployed it into something called like what I call the strike convexity trade. I'm going to break it down for you a little bit. Never had to sell her Bitcoin. David in Arizona, 1.5 million in dormant capital, activated about 40% of it. Now he's generating about 90,000 a year passive. Now, we've had hundreds and hundreds of people that have gone through this system that all have similar results. What about me? Well, I told you in 2008, I lost everything because I didn't have this system set up. I didn't have a liquidity system. Then from 2009 to 2015, I earned a lot of money, but I was building little to no wealth. I was paying cash for everything. I was playing the income game. But then as soon as I switched to the treasury game, everything changed. From 2015 until today, I built 5 times more wealth than I had done the previous 15 years combined, even with building and selling 2 big exits, 2 big companies. And that's what the base engine does. Okay, so now let's jump into engine number 2. So we've got the base engine. We understand how that works. But now, how do we start to put more power in that? Right here, that's the question. Let me ask you a question. How much are you paying in taxes this year? How much do you expect to pay in taxes this year? 50,000, 100,000, 200,000. What if I told you you could redirect 50, 70, 90% of that back, and you could redirect it into your own assets instead of giving it over to your government? Okay, that's engine number 2. It's called the supercharger. Now, if you were able to do that, let's say over 20 years, that's 600,000 to maybe 1.2 million that you keep instead of giving it away. How do you do that? Let me show you. So probably the number one objection I hear when it comes to building your own wealth engine and building wealth, and I've seen a bunch in the chat already, is I wish I had that much money. I don't have that much money. I can't save that much money. I can barely afford to live. And I hear all these things, right? All these reasons why we don't have any extra money. And I understand it's tough, right? Like I said, I'm making 100 grand. 40,000 goes to taxes. How am I supposed to live on 60? I can't live on 60. So maybe I put 5 grand or 10 grand away. I understand it. So if the number one objection is I don't have enough money, how can we speed that up? Well, here's what it looks like. Again, if you make 100 grand, you're paying 40 grand in taxes. You probably don't have anything left to invest. Maybe you earn 250,000 and you pay, 75, 80 grand in taxes. Probably nothing left to invest. If you earn 500,000, you pay 175,000 in taxes. Nothing left to invest. And I know a lot, I'm not looking at the chat, but I can already hear it. Like, Someone is making 100,000 is like, well, if I made 500,000, then I could have extra money. No. You see, it's not the amount of money that we make, it's the way we approach the game. I talked about this quite often. There's a game called Cash Flow. Robert Kiyosaki, my mentor, created it. It's a very educational game. I would recommend you play it. But in that, you draw a career card, and you start off like as a doctor or a plumber. And it tells you how much money you make. And then you randomly draw the card. But when I play with my kids, I just automatically give them the highest paying card. And I automatically start with the lowest paying card. I'm making 20 or 30 grand a year. They're making 150, 200,000 a year. And I can beat them every time. And not just beat them by a lot. Because it's not how much income we make, it's the system that we use or the way that we approach the game. Now, again, if you're thinking I don't have enough money, no, let me reframe this for you. You do have the money. You do. The problem is you're giving it away. Let's look at the cost. So if I make $100,000 over 20 years, I'm giving away $5.1 million. If I'm a $250,000 earner over 20 years, I'm giving away 11.8, almost $12 million. If I'm a $500,000 earner, I'm giving away almost $30 million over 20 years. The money's there. You're just not reclaiming it. Saw a lot of people putting some tax amounts in there right now. All right, let me show you how we can start to reclaim that. I see some big amounts in there. Okay, so here's how we can do it. Here's how the supercharger works. What we want to do is we want to use debt to buy tax depreciation assets. So let's say that I could reclaim 50%, maybe up to 95% of my tax bill. I then deploy those reclaimed taxes that I've already made it, I would have given away. I now reclaim it and I put it into compounding assets. The best part is I do it $0 out of pocket. Now, I'm not going to teach you all the mechanics of how to do this right now. That's what we do on our personal treasury audit. But let me show you the math of how this works. Okay, so here's how it works. If we have three different income levels, if I'm a $100,000 earner, I'm going to pay $40,000 in taxes. Again, nothing left to invest. But if I use the supercharger, I would say borrow $30,000 against wherever, a credit line, a HELOC, a credit card, whatever. Borrow the $30,000 to buy $30,000 of depreciation. So it costs me nothing out of my pocket. How do I get that? We'll talk about some ways to get that in a second. But now I have, let's say, $90,000 in tax depreciation. That's a 3 times multiplier. So now I get to write off $90,000 in tax depreciation against my $100,000 of income. So my new tax bill, instead of 40, is now 4. I've just reclaimed $36,000. I didn't spend any money, 0 out of my pocket. I reclaimed $36,000, and I can deploy that into assets. And if I do that for 20 years, that's almost $10 million. I didn't make any more money. I didn't make a single penny more. I didn't work an extra hour. Well, I had to work some hours to set this up. If I'm a $250,000 earner, same playbook. I borrow $50,000 against some credit line that I have. I buy $150,000 in tax depreciation. I reclaim $52,000 per year that I already made. I'm giving away. I can now get to invest. That could be 13, 14 million in 20 years. If I'm $500,000 earner, same thing. I buy $300,000 in tax depreciation. I reclaim $100,000 per year. In 20 years of doing that, that's almost $30 million. All right. That's what you're gaining when you use debt to reclaim taxes, because it's $0 out of your pocket. I didn't spend any money. I ended up with more money at the end of the year instead of less. Now, let me show you where we get to the 3 times or 5 times tax depreciation. So a couple examples. John in Texas, he's a W-2 earner. And again, this doesn't matter if you're a W-2 earner or you're a business owner. He's making $150,000 a year, paying about $45,000 in taxes. We showed him one move. He's able to drop his tax bill to $12,000. So he's saving about 33 grand a year. 3 years later, he's reclaimed about 100 grand over those 3 years, and he's deployed it all into assets. And at the rate he's on, that should be about $2.6 million in 15 years. What was the move? I'm going to show you exactly these tax depreciation moves. But before we do, Lisa, same thing, $200,000 earner, paying about $80,000 in taxes. 2 different moves for her. Dropped her tax bill to $15,000, saving about 65 grand a year. Over 5 years, that's now about 325 grand. Compounding at a conservative rate, that's about 7.8 million in 15 years. But remember this base engine? We had to build the 4-layer liquidity stack first. That's a 300 horsepower motor. Then we added a tax supercharger on top of it. So she used a business line of credit to buy solar tax credits. One of the ways that we buy depreciation, solar tax credits. And now she has a 650 horsepower motor, the base, plus supercharger on it. Back to John, he had borrowed about $80,000 from his home equity line of credit. So again, $0 out of pocket. He bought one of my favorite ways, Bitcoin miners. I know right now the price of Bitcoin's plummeting today. So people are like, what? Why would you ever buy that? We'll answer that at the Q&A at the end. Bought Bitcoin miners, and we were able to get about $240,000 in tax depreciation from that. It's about a 3 times multiplier. That's the supercharger. So we have to build the collateral map first, because that's the base engine. Then we add the debt and the tax depreciation on top. That's a supercharger to get to about $650,000. What do I do? Well, each year I go, what do I calculate should be my approximate taxable income for the year? Then, now that I know my target, this is what I expect to be my taxable income. How much depreciation do I need? So I'll use debt to buy tax depreciation assets to offset that taxable gain. That way I can reclaim a really large portion of the taxes each year, and I can put that right back into assets. My goal is to take 100% of my income and going into assets, and then my assets to pay for my life. Now, I built the base engine, then I stacked the supercharger on top of it using debt and depreciation. That's how I was able to build, 5 times more wealth in just the last 10 years than I could the previous decades before. Right? That's a 650 horsepower motor. We're not quite to the 1,000 horsepower motor yet, but we're getting there. But here's the final piece. We can have 2 people, same net worth. So let's say they got to the end of their life, they managed to save, $5 million. Person A lives off income, so it's all being taxed. So they're pulling $200,000 per year, paying about $60,000 in taxes, living on what's left, about $140K. 20 years later, net worth $2 million. But he has to sell his assets to live. Person B lives off debt. The reason why we live off debt is it's tax-free in any country. It doesn't matter what country you're in. You don't tax debt. I could borrow money against my assets and pay $0 in taxes. I could live on the $200,000. That means 20 years later, my net worth is not $2 million. My net worth is now $15 million because my assets kept compounding the entire time. Remember, only income is taxed in every country. Debt's never taxed. It's what Robert Kiyosaki does. It's what Donald Trump did before he became president. It's what all billionaires do. You use debt to reclaim taxes. You use reclaimed taxes to build assets. And then you use assets to fund your life tax-free. That's the supercharger. Now, on the personal treasury audit that we can help you with, we could build out your base engine, the 300 horsepower, your collateral map, your 4-layer liquidity stack. Then we add the supercharger. We map out your debt sources, your tax depreciation strategy, and then we'll add the nitrous, the 1,000 horsepower. But here's the question real quick, or we want to figure out first, is how much dormant capital are you sitting on right now that could be doing 5 jobs instead of 1? 100,000? 500,000, 1 million, 2 million. Most of you have dormant capital that you're not even aware of. You don't even know the number, but don't worry, that's what we're going to work on right now. So over the next 8 minutes, probably 8-10 minutes, I'm going to walk you through the exact audit, and then we're going to find out what your number is, and this is going to be the nitrous oxide. Okay? Now, hopefully you have your pen and paper out. All right, put a thumbs up. Put a thumbs up in the box. If you have money sitting in either home equity, a 401k, IRA, some sort of a stock brokerage account, a savings account, Bitcoin, cash, business equity, any of those things. Yeah, almost everybody. Almost everybody. Now, that's what I call lazy or dormant capital. Why is it lazy? It's lazy because it's capital that's doing only 1 job, maybe 0 jobs for some of you. Now, like most people, we're going to get to this in a second. We're going to figure out what your number is. But maybe, like I said, you're maybe sitting on 100,000, maybe some of you millions, and you don't even know it exists. So I want to walk you through that and show you what happens if we were just to activate even just a little bit. Okay, so here's the audit. There's 5 sources of dormant capital that we'll walk through right now just for time. So I want you to fill this out or write these numbers down as we go through it real quick. Don't overthink it. Just put rough numbers. Just put rough guesses. Like this is, you're not filing your taxes right now. This is just for our workshop here. Okay. So number 1, think about your home. How much is your home worth? 200,000, 500,000, 800,000. Okay. So how much is my home worth? How much do I owe against the house? It's worth, I don't know, 800,000. I owe 400,000. So I have home equity, 400,000. Write that down. Let's say I have retirement accounts. I have a 401k, an IRA, something like that, SEP IRA, all that money, right? It's capital. So I have 600,000 in a 401k. It's locked up. Yeah, I mean, it's earning money. It's doing a job. It's not zero. It's not cash. It's earning whatever, 8%. But you can't deploy it. Okay, write that amount down. Then we have like investment accounts. So if you have, brokerage account with stocks, ETFs, maybe some Bitcoin in there, things that you're just holding. You're not selling it, you're not deploying it, but it's sitting there, growing, doing its thing. So maybe you have, $400,000 in your Bitcoin, stocks, ETFs, things like that. Again, you're not selling it. It's doing one job. It's appreciating. Write that number down. Okay. Now, maybe we have cash and savings. Hopefully some of you have savings accounts, CDs, money market accounts. Maybe you're earning, 1%, 2%, 3%, maybe 4% on it. While inflation is running 10% as you're losing money. Whatever that amount is, roughly, just write that number down. And then some of you, not all of you probably applies to this, but if you have a business, how much is that business worth? Not revenue, but like equity value. Like if you sold it today, maybe it's like a small business, maybe it's hard to sell, but like what do you think the equity is worth in that business? Write that number down. Do you have a $500,000 business? A $300,000 business, a $3 million business, write that number down. Now we want to do just real quick. Again, this is not comprehensive. You're not filing your taxes here. Just write that number down and then add it all up. Okay. Now add that up real quick and then just go ahead and just drop the, if you want, drop the amount in here. Drop the amount of what we call lazy capital in the chat. We'll get to the lazy capital in a second here, but just drop that number in. Is it 200,000, 500,000, 1 million? Here we go. 50,000, I see. Okay. 465,000. Okay. 1 million. There we go. 560, 800,000, 750,000. Okay. 250,000. 555, 3.2. Okay. 4.3. 800, 1.2, okay, 2 mil, 3 mil, 4 mil, $20. John, you're in the wrong room, man. 20 bucks, can't do much with that. 900,000, okay, so good. Just making sure you guys are doing that. Let's keep going through this. Okay, so I want to show you what lazy capital is costing you. What does that mean? Now, first of all, to understand what I'm talking about lazy capital is, here's the problem, right? So for a lot of us, we're probably maxed out on how much revenue we can make. We're working already 40 hours a week or 50 hours a week or more. We have a side hustle, a side job, whatever, maxed out, can't work more, don't want to work more, but your money, those amounts that you just dropped there is doing 0 jobs or 1 job. You're exhausted, but your money is lazy. You're thinking of getting a second job or a side hustle, but your money just does 1 job. So I use this equation. It's called the velocity of money. So in economics, the way the government reports the health of the economy is velocity of money. It measures how much economic activity there is, GDP, let's call it that, but divided by how much money there is. So for example, if I take a $20 bill and go buy lunch, then the guy at the lunch spot gave the $20 to his food supplier. The food supplier gave the $20 to the gas station. The gas station gave the $20 to the person stocking the shelves, and that person gave it to their employee. Okay, now that same $20, one $20 bill, moved 5 times through the economy, so it created $100 of economic growth, but there's only $20. Now, the velocity of money measures how fast that dollar moves through or how much wealth gets created from one $20 bill. So we can do the same thing. We can think about how much wealth have we created, just like the government measures the economy. How much wealth have we created for how many dollars have we put in? So just like that $20 hypothetically moved through 5 different hands very quickly, how many investments can we get $1 to move through at any given time? That's velocity of money. That's how we get our money doing 2 jobs or 3 jobs or 5 jobs instead of you having to do that. That's what I'm talking about by velocity. Now, we saw a bunch of numbers there from $20 up to $3, $4, $5 million. And it's doing one job. And it's growing. I mean, you got it in your stocks. It's in your house. So that money's in the house is growing. The money's in your 401k. The stocks are growing. It's doing a job. Not bad. But what if that same million, instead of doing one job, did 5 jobs at the same time? It could grow 5 times as fast. It could be a collateral. We could borrow against it for tax-free liquidity. I could deploy it to that borrowed capital into cash-flowing tax-advantage assets. I could reclaim taxes via depreciation. I could deploy those tax savings into more assets. My original capital never gets sold. It compounds uninterrupted, creating generational wealth. If I got the same dollar, same 1 million doing 5 jobs, maybe instead of growing to 15 million, it grows to 84 million. We're talking like a 60 million gap over 20 years. And a lot of you are shocked by these numbers, but maybe a lot of you haven't really thought through what compounding means. We're going to get to that. But the thing is that you don't have to activate all your capital. But let me show you what would happen if we activated, just say 50% of it. So let's say scenario number 1, and you can work with me. So you have your numbers there. Just do the math. Take 50% of the number that you wrote down. So if you wrote $1 million down, put 500,000. If you put 500,000, put 250. You got that. Just put whatever 50% is. Scenario 1, you activate 0%. So your money, it just continues to do one job. For 20 years, it's growing at 8%. Or scenario 2, we take 50% of that money, so the half of whatever number we had, and instead we get it to do a second job. We run it through the velocity engine. It's doing 5 jobs over 20 years. It could do another 40 million. Just by activating 50%, it's doing nothing. And so what I mean by this is like dormant capital. So I have my home. My home is going up by 5% a year. And I have equity in the home. And whether the equity sits in the home, so let's say it's $1 million home, I have 300,000 of equity. The home's going up at 5% a year. Whether the equity stays in the home or not, the home's still going up at 5% a year. That's what we're talking about. But let me show you what happens if we don't move it. So here's what it costs us if we do nothing. Find yourself in this table based on this dormant capital that you just found. If you have $1 million in equity right now, you could do nothing. That could probably grow to $2.5 million in 20 years. Or I could take half of it, activate 50% of it at a 20% compound annual growth rate, and that could grow to 20.7 in 20 years. That's an $18 million difference just by activating 50% of my capital. I didn't work an extra hour. I didn't make an extra dollar. But it's an $18 million difference. If I have 2 million in equity, I mean, do the math, right? It's if I had 2 million in equity, then it's 5.3 million in 20 years. Or if I activated 50% of it and I let it compound at 20% for 20 years, that's a $36 million difference. Now, this isn't theoretical. This is math, right? This is just math. The law of compounding. A lot of you don't really understand what that means, which is why we don't sell our assets. We don't pay taxes. Every single day you don't activate your dormant capital, again, I broke it down, you're losing $1,100 every single day. But let me show you what it looks like when you do activate it. So there's 4 core tools that the wealthy use to accelerate wealth. We use credit, and that's what funds our acquisitions. We use equity, and that grows through our appreciation. We use then leverage, which unlocks that growth as collateral. And then we use arbitrage, which captures the spread profit. So the profit gives me more credit capacity. And then I repeat that. When I put all four together and I know how they interact, it's what separates velocity capital from lazy capital. The reason why you have to work so hard is because your money doesn't, but we want to end that. So we want each tool, and each tool alone is useful, but when we combine them, they're transformational. Let me give an example of one way that we can activate some dormant capital. So this one, maybe today it's not your favorite one as of today, but I like it. I call it the strike convexity trade. So let's just say hypothetically you have a home. A lot of you said you did. And in that home, you have some equity. So you decide to use I decide to get some of the money out of my equity. How do I do that? Well, I could refinance the home. I could do a home equity line of credit. There's a bunch of ways we can do that. Maybe you don't have a home. Okay, so then get a business line of credit or use a credit card, like fill in the blank. You know how to get credit. But I could borrow against my home at, let's say, 8%. So I take $250,000 at 8%. And then I take that $250,000 and I deploy it into this strike convexity trade. Now, what I'm going to do is I'm going to buy this strike position. It's a stock. It's a preferred stock. And the first question you're probably asking is, but wait a minute. Now I have this debt that I have to pay at 8%. Sure. But the asset that I bought is a cash flowing asset. So what happens is the asset is now bringing me cash. If I borrow $250,000 at say 8%, it's going to cost me $20,000 a year. But when I buy strike, it's giving me income every year of say $23,000. So once I pay the debt, I'm still with a positive 3%, but that's the arbitrage, but that's before we even put the taxes in. Now we can talk about the payment on the loan is tax deductible, and the income I'm receiving is not actually income, so that's not taxed either. So it's like maybe like a 5 or 6% arbitrage. So now, just for sitting in this position, I'm making 5 or 6% per year, just for opening up the trade. Now, there's the convexity is the potential upside. So if Bitcoin continues going up over, let's say, 5 years or 10 years from now, which I expect it to do, we'll talk it later about where's it going to be in a month or two. I'm sure you want to know where I think it's going to be in 6 months or a quarter, but in 5 years or 10 years, do you think it's going to be higher than it is today? Okay, so then what I can do is I can play the long call option. I'm making a 5 or 6% positive spread, earning positive cash flow from waiting. And then if Bitcoin gets to 500,000 in 5 or 6 years or 7 years or 1 million in 6, 7 years, whatever, it can convert into common stock that could be worth $600,000. $800,000. So I borrow $250,000. I have dividend paying stock that's paying for the debt plus giving me a positive carry, $9,000 a year in positive carry for waiting. Over 5 years, it's made me about $50,000. And at that time, assuming Bitcoin continues to grow over the next 5 years, I can convert it over and maybe make $400,000 or $500,000. And it cost me $0 out of my pocket. $0. I use that from debt. Now, in order to do this is like interest arbitrage. So I'm earning 9%, I'm paying 8%. That's net positive. I'm making money while I wait. I'm using tax arbitrage. So it's 8% interest, this tax deductible. So it's like a 5% after tax rate. I'm using inflation arbitrage. The beauty of this is that the debt is 8%, but inflation shrinks the cost every year. I get a payback with cheaper dollars. I'm using the asset convexity. So Bitcoin has been growing at 50% a year. Not every single month. I can't wait to see the comments or the questions in the Q&A and we'll get to here later, but not every month. But when you look at it over 2 years, it's 47% over the last 2 years. Well, as of about a week ago. No liquidation risk because I'm borrowing against my home. So there's no margin call there. There's no forced liquidation. So this is one example of how we can engineer wealth, right? This is how treasurers think. And this is just one move. Now, in a personal treasury audit, we build 3 engines. The base engine, the 300 horsepower. That's your collateral map, the liquidity stack, the risk policy. We do the supercharger, right? This is the debt and tax depreciation roadmap. And then we put on the velocity engine so we can figure out how we can activate 10, 20, 30, 50% of lazy dormant capital and make it do 2, 3, 4, 5 jobs. All right, that's a lot. We covered a lot. Let's recap real quickly what we learned. So we learned engine number 1 is the Treasury operating system. And the Treasury operating system is our base motor that takes us from earning income, paying taxes, paying for our life, and then hopefully having a little bit left over to save. And then after 40 years, I have to sell all my assets, and hopefully I die before I hit 0. It gets us off of that, and instead it puts us onto a Treasury. So I take my income and I buy assets. My assets grow faster than my cost of living going up, and my assets pay for my life. That's what the Treasury operating system does. Number 2, we learned about the supercharger. We learned about income and tax reclaim system. We didn't really get into the income side of things. I only had so much time here. Like I said, I taught all this through 3 days, and we still didn't cover a lot of it. But there's the tax reclaim. So how can I use assets and debt to get tax depreciation to offset my income? So now without having to work harder or make more money, I have more money to put into assets. We learned that. And then engine number 3 was the wealth velocity system. So now we've learned what lazy or dormant capital is. And we've run some of the scenarios and numbers that were if I were to just activate a little bit of that and put it into a compounding growth rate of something 10% or 20%, how that could be millions of dollars. Little things become big things over a long period of time. And I know you have a bunch of questions. We're going to open up a live Q&A in just a minute. I'm going to sit down and we're going to hang out and I'll get through all your questions. But you found your dormant capital number. You wrote it down. You saw what happens when you activate 50% of it. You know what it's costing now every day to wait. But now I just want to show you real quick what's inside a personal treasury audit and how you could book yours if you want. It's about a 45-minute one-on-one strategy session where we build your 3-engine system. Let me just walk you through what we build out together. So what's in the personal treasury audit is first to get the balance sheet x-ray. So we learn what are all the assets that we have and what tools in our toolbox are they? We'll go through every asset you own, how we classify it. Is it collateral? Is it productive? Is it a lifestyle? Is it a deadweight asset? And you'll walk away knowing exactly what you have and what it's doing and how to use it properly. Deliverable number 2 is the dormant capital audit. Now we're going to find all the money. Like this was just a quick brainstorming. We'll show you exactly how much you're leaving on the table. We'll run real numbers, real scenarios, not rough numbers, but precise numbers. Deliverable number 3 is the personal treasury map. So this is where we build the collateral map, your 4-layer liquidity stack, and your risk and leverage policy. This is all building out our base engine so we don't blow ourselves up. Okay. Deliverable number 4 is the tax reclamation roadmap. So we can show you 14, 15 ways right now that you could start getting money back, reclaiming money from taxes. The 4 or 5 favorite, tax depreciation plays that we do. You can map out your debt sources, your HELOCs, your credit lines, your margin loans, all of that, the full tax depreciation strategy. This is the supercharger. And then finally, deliverable number 5 is the 50% activation plan. And this is where we show you how to activate 50% of your dormant capital and make it do 5 jobs at the same time. All right, now, if you were going to pay for it, it's a value of about $6,500. However, we're going to offer this call for completely free of charge to you. I know that sounds crazy, right? Why would I give you $6,500 of value for complete free? Well, here's the thing. Normally, I would charge that. That's what we charge clients who come to us cold. But I want to give it to you for free because, well, I know you want to know what the catch is. So here's the catch. I know that some of you, not all of you, and actually not most of you, but some of you are going to walk out of that 45-minute audit and say, wow, that's amazing. I can't wait to go implement this. And some of you are going to say, I could use help implementing this. And you might want to join the Wealth Operating System program. Now, the Wealth Operating System is a 12-week implementation program where we implement everything that we mapped out in your audit. So we're going to give you the audit for free because I want you to see exactly what you're sitting on. I want you to see the opportunity that you have right in front of you. And only if you're a right fit, then I want you to join the Accelerator program. But again, this is not for everybody. Not everyone's a right fit for the program, but everybody can get the system and walk away. But real quick, let me tell you what it's not for. Right? This audit is not for everyone because it's not, some of you said you have $10 or $2. It's not for you. right? This is, if you have no income, if you don't have income of say over $100,000, you don't have assets over 250,000, this isn't for you. This isn't like how to make money. You have to already be making some money. If you don't have any money and you have no income or assets, then the system's not going to work for you. You're not ready for the system. It's also not for people looking for a get rich quick. Like, I'm not going to tell you what meme stock to buy or, you know, whatever, some crypto token. It's not a get rich quick program. This is a wealth building system. Okay. So it's not like a lottery ticket. It's not a scheme. It's not moonshot. So if you're looking for, you know, a lottery ticket, this isn't that. But if you do have some income and you do have assets and you're serious about building generational wealth over the next, you know, 3, 4, 5, 10 years, if you're ready to implement something, then this call is for you. All right. Now let me show you exactly what else you get. So the balance sheet x-ray, figure out what all the assets are. The dormant capital audits, you can go through in great detail what all the different assets that you have and how you can deploy them. Personal treasury map and the tax reclamation. I don't know if I wrote that right properly, but the roadmap. We'll go through all the different ways that you could save tax money and redeploy that into your assets. Let me just ask you one more question before we jump into Q&A real quick. By the way, I'm not going to answer questions from the chat. There's a box that says Q&A. I'll be answering questions from the Q&A. But what happens if you don't book this call? What changes? Well, I'll tell you, nothing. You'll just keep working hard. You'll keep paying more in taxes than you probably should. You keep your money stuck doing one job at a time. You'll keep wondering why it feels like you're just stuck treading water. But how long do you want that to continue to happen? Right? On the other hand, if you invest, say, just 45 minutes into a phone call and it saved you, say, I don't know, $25,000 in taxes just in year one alone, what if that single move would let you invest in a cash flowing property, right? Or pile into Bitcoin right now while it's on sale? What if those 45 minutes became the single most valuable hour of your financial life? Now, this call costs nothing, but what you could gain could change everything. So just click the link there. Should be up in the chat. Grab a spot. They're going to go really quick. There's a lot of people on this call right now, but let's build your personal treasury map together. Right before another year slips by. Right before you lose tens or hundreds of thousands of dollars more to taxes and to inflation and to bad advice. Now, while you're booking your spot, I'm going to leave this open. I'm going to go ahead and open up for some live Q&A. Because I want to make sure you leave with total clarity. So if there's anything on your mind at all, now's the time to ask. Now, of course, I prefer that you'd ask questions about what we just covered, but I know everybody wants to hear me talk about Bitcoin, so we'll see what those questions are. I see a bunch of questions already coming in. But while we do this, while I'm answering, go ahead, click the link, book your wealth mapping session now, just book a call, all right? Because that's where we can go into like, more personal, personal situations. All right, I'm gonna grab a chair and let's open up the Q&A box if we can. There we go. All right, yeah, we're at the top. All right. So Glenn Genova is asking, what if someone is starting with a paid off co-op worth $150,000 but little cash? Work full time, but essentially starting from scratch. What do you recommend for someone in my situation? Well, Glenn, I need to know a little bit more about what you mean by your co-op worth $150,000. But let me say, if I had assets and I didn't have a lot of cash, so that's sort of like what Michael Saylor found himself in. I had some assets, not a lot of cash. I couldn't increase the revenue. I mean, number one, you're going to need some revenue, and $150,000, Glenn, is not going to be enough to retire off of. This is not magic that way. So you're going to need some income. And $150,000 is not enough to retire off of. So without any income at all, I guess what I'd recommend for somebody in your situation, Glenn, is figure out how to start making a little bit of income. Then what we can do is then we could start using some of your assets, the $150,000, to get the system going, right? So step one would be to get some tax depreciation to keep more of your hard-earned income so you can deploy it into assets. But since you don't have any income, that's not going to help you. Now, you could be retired and have a lot of assets and no income, and this could still work for you because you have assets, but you really have neither, Glenn. So that's where you'd start. Okay. Question from Farhad. What are the benefits of holding MicroStrategy? Do I get any dividends for holding it? And how can I create compound income with holding MSTR? What platform do you hold? I mean, I'm not here to sell you MicroStrategy stock, so I'm probably not going to answer that one. No, you don't get any dividends for holding it. You do get, because the goal of MicroStrategy is to increase the amount of Bitcoin per share. So it's sort of like a dividend stock because they're increasing the amount of Bitcoin you own per share. So it's sort of like a dividend stock where they reinvest the dividends for you. But again, Farhad, I'm not going to get deep into MicroStrategy. I'm not here to sell you a particular stock. Question from Gary Haldsworth. What if I don't have 20 years? I'm 75. Well, Gary, it's a great question. So what if I'm 75? What if I'm 25? What if I don't have 20 years? What if I have 5 years? So this is how it works. If I wanted to go somewhere, doesn't matter what country I'm in, I could open up my phone, I could open up an app like Google Maps, and I could put in a destination of where I need to go to. So for you, Gary, I need $3,000 or $7,000 a month. So that's my destination of where I'm trying to go to. Then the next thing it asks me is, where am I starting from? So then I'd say, okay, well, here's my starting location. And then it would give me options. Do you want to go by train or by bicycle or walk or fly? And so, Gary, what we'd have to do is just figure out, where are you trying to get to, Gary? And then where are you starting from? And then how do we make that work? And that's what we do. You don't have to wait 20 years, but I don't know where you're trying to go, nor do I know where you're starting from. Question from Enrico Lodo. Reclaim tax is only applicable to USA. No, Enrico. As I said, like, most of the developed world, now there's 170 countries. I can't speak for all 170, but most of the developed world has very similar tax incentive programs. As a matter of fact, this last year I went to China. I think it was August or September. I went to China for the first time in my life. And I was very surprised because I think of China as like communist China. I was very surprised as I learned that their tax code is very, very similar to the United States. As a matter of fact, they actually have a lot more tax incentives in certain areas, like investing into R&D credits and things like that, than we even do from the United States. So again, these are principles and they're applicable to most people, but like Canada has the same thing, but it's called something a little bit different. And so we can apply it in different ways. Question from Joseph Hill. If you were in your 20s today and had to start over with only 80,000 to your name and making 120,000 per year, where would be your first place you deploy your capital to start generating cash flow, your layer one base? So Joseph, if I was 20 years old, I would not be deploying capital into cash flow. I'm 20 years old. What do I need cash flow for? I would be trying to build capital base for appreciation, not cash flow. Even at my age, I'm a lot older than 20 years old, and I'm not investing for cash flow either. I'm investing for appreciation. Now, at some point, maybe in the next 5 years, I might decide that I want to work a little bit less, and maybe I'll take some of my capital and move it into cash flow. But right now, I don't have that. So to answer your question, Gary, if I was 20 years old, I would not be investing for cash flow. I'd be taking that 120,000 of income you have per year. I'd be getting as much tax depreciation as I could so I could deploy as much capital as I could into assets that could start growing for me much faster. Question from Jesse Dobbs. Please explain the miner's tax write-off. I don't want to get into the details and the weeds of in any specific things, but here's how it works. When I buy assets, capital assets, they have an expiration date. They go bad. If I buy a house, or I buy a car, or I buy a new piece of machinery for my factory, or I buy a new truck for my crew to run out and do jobs with, that can be, I know that car is going to be worth zero at some point, the house, etc. And the government allows me to get depreciation from that. Now, Bitcoin miners are capital equipment. They're computers that do work and eventually go down to zero. And so I can use that just like any other asset, and I can capture that depreciation and write it off against income. So that's how that works. It's funny, everyone is talking about, I joked in the beginning about, do you want to just skip to part number 3? And I said, we can't skip to part number 3 because we have to build number 1 and number 2. Everybody here seems to be wanting to skip to number 2, which was the turbocharger, the tax piece, but you can't really do that without building number one.